With that, it's 1 p.m. On March 31st, 2026. We are on the land-grant campus of the University of Illinois in Urbana-Champaign. I'm Joe Janzen, agricultural economist from the University of Illinois and a member of the farmdoc team. And this is a farmdoc webinar discussing prospective plantings and the grain stocks reports for corn and soybean market outlook. I'm joined today by my colleague, Scott Irwin. Hi, Scott.
Hi, Joe.
Behind the scenes, as always, we've got Mr. Jim Baltz keeping us in line and on task. Hopefully we'll get through a number of topics of conversation today. Here's an outline for what we're going to discuss. Two big reports released by USDA just a couple of hours ago that are especially pertinent to corn and soybean markets. The first one being the grain stocks report. So we'll just talk about what was released by USDA, their March 1 grain stocks estimates, which really have potentially major implications for the 2025-26 marketing year, what we call the old crop usage situation. And so we'll talk about that supply and demand situation and maybe how our understanding of it has changed relative to where we are at just a few hours ago based on these new USDA numbers. Then we'll move into discussing the crop that we're going to produce in 2026 with data from the Prospective plantings report. USDA has estimated acreage for all crops, but especially we'll dig in on the corn and soybean planted acreage estimates, which tends to be relatively informative about our expectations for crop size and supply and demand in the new crop, the 2026-27 marketing year. Finally, we'll wrap up with just sort of thinking about how did the market react to the report, and then sort of our thoughts on where does this put us at going into the crop planting cycle. I know I've seen some planters rolling here in central Illinois already, but we'll get into the heart of spring planting season here very soon. So with that, let's begin. Before we begin, we just sort of, it's good to level set a little bit and think about where the market is at today. These graphs just show the nearby futures price. That's the lighter orange and green lines in each figure, and then the new crop futures price, which really is the price we would expect to be most closely aligned with expectations for the 2026 crop production cycle, the one that we're about to start planting here in the U.S. Midwest. We've seen prices for both corn and soybeans rally in the really since mid-January, but especially here in early March, given all of the commodity market events surrounding the conflict in Iran, which has implications both for energy prices, for fertilizer prices, and also just sort of for the demand for commodities, putting us at a new crop futures price right now for corn of about $4.83 as of the close of trading yesterday, and $11.43 for soybeans. New crops, old crop soybean prices slightly above that level. Old crop corn prices slightly below that level, and we'll explain a little bit why when we dig into the supply and demand situation. But really, prices moving to sort of slightly elevated levels relative to long-run history. If I had made these slides 3 months ago, I would have certainly said, we're in this period of prices at or around long-run levels in that sort of 450 corn, 1050 soybean kind of area. And we've really kind of moved away from that. And there's some reasons why that we're going to discuss in today's presentation. We'll begin by talking about the quarterly grain stocks report. Just as a sort of point of information, this is an estimate produced by USDA based on a really thorough survey of commercial grain handlers, and then a farmer survey estimating inventories held on farm, and really reported as of a report date of March 1st. So this really represents the amount of grain that we believe was in storage as of about a month ago now. And so that's the number that we're looking at. Obviously, things may have changed since then, but it's a relatively high frequency snapshot of what's happening with sort of and how we are using up the crop that we produced back in 2025. This graph just shows the latest number. We do see U.S. corn stocks growing year over year reaching the highest level that we've seen in this period, the last 15 years or so. USDA coming in with a quarterly grain stocks estimate of 9.02 billion bushels. That's up almost 800 million bushels from a year ago. Came in slightly below the average analyst's guess of 9.104 million bushels released by Reuters in the survey that they did. So growing stocks year over year. A lot of that growth was seen in on-farm stocks. So we saw 20% year-over-year growth in on-farm stocks, really very little, limited or no growth in off-farm stocks. So the farmer appears to be a fairly large holder of corn, Scott, as we come out of coming out of the harvest period and into the sort of the latter half of this marketing year.
Yeah, there's no doubt that farmers have kind of loaded up on their old crop stocks.
All right. Again, this was, the estimate coming in slightly below the average trade guess. So this graph just shows the history of sort of these trade guess misses, if you will, over the period since 2014. We see, really a number of years, 7 years in a row, where the USDA has surprised downward, sort of more estimated use, if you will, than what the trade was estimating in their guess about what the grain stocks number would come in at. So we're this year 80 million bushels below the trade guess. We can take that number and think about, well, what was the drawdown in grain inventories? How much did grain inventories change from December 1st, our previous quarterly grain stocks estimate date, to March 1st? And that really tells us something about how are we using up what was a very large U.S. corn crop. But let's remember, we planted very high corn acreage levels that we hadn't seen in decades, and then produced above average yielding crop. That 186.5 bushel per acre national yield estimate. All that things led to what was a pretty big crop that we needed to see get used up if we weren't going to see much lower prices. USDA saying, yes, indeed, we're using up that big crop. Estimated implied use was 4.28 billion bushels over the quarter ending March 1st. But in particular, the thing to take away from this graph is that usage surprise. How much more use did USDA estimate than the trade was expecting? And there, I think there's a really interesting story about now 7 years in a row, really since from 2020 till the present, where USDA's usage estimate has surprised to the upside. And Scott, I know this is a fascinating data point that you might help us kind of understand in more detail.
Sure. So first off, the way I would characterize it is if you look at the top part of the graph, we see total use growing. And what the bottom chart shows is for the last 7 years, it's not that the market didn't understand that use was growing, but the market was continually surprised by how much use was growing compared to what the USDA quarterly grain stocks in the second quarter of the marketing year were showing. And that's a really unusual pattern from what we've seen in the long term. Joe and I have access to this data going back into the early 1980s, and there really isn't another period where you see in the second quarter of the corn marketing year a continuous sequence of the market being too low, which brings us back to an age-old problem, if you like, in the corn balance sheet. When you see things like this, does it mean that the market is simply underestimating second quarter use consistently for 7 straight years in the second quarter? That's a possibility. The other possibility is because of the way the corn balance sheet works, where you have such a large component in what we call feed and residual, which is an implied number, we never know whether surprises like this are because they're true usage surprises, or that the USDA over or underestimated the crop in that particular marketing year. One interpretation, therefore, is that what's been going on the last 7 years is that the market's right on usage in terms of, if you will, truth in air quotes, and the USDA has been slightly overestimating crop size over this period. And that shows up in the second quarter because that's the first quarter after we get our final production estimate in January. So it's kind of a complicated story, but that's possibly one interpretation of what's going on. And the data suggests that whatever is driving these series of positive surprises, they disappear by the third quarter because the market is adjusting upward its usage numbers to catch up with the USDA.
Certainly, if we move to the third quarter numbers, and we've done that, we don't have a slide for that here, but we don't see the same pattern. It really doesn't show up. And that would sort of say this isn't really so much about usage as it is about kind of calibrating usage against the crop size, which is still sort of a really hard thing to pin down when it comes down to a 17-ish billion bushel U.S. corn crop.
Yeah, because we're not talking about billions of bushels. We're talking about hundreds of millions of bushels. And I think it is still a salient, really interesting point because, in particular in the last crop, we know that there was kind of this anomalous rise in harvested acres as we've gone through. Does that mean that the 2025 crop could have been overestimated a few hundred million bushels that would explain all this? Possibly.
I think so. So moving into the balance sheet where we can actually see that, I mean, this graph just shows 2 marketing years ago, 24-25, the latest USDA numbers as of the March WASDE, and then sort of any changes that we might think might be made to that balance sheet, of which there are none on this graph. You'll notice that last column is equal to the middle one, but it shows that big U.S. corn planted acreage, the number that, as Scott mentioned, kept growing and growing. That yield number that really kind of kept, well, it's lower than some of the estimates that were released during the marketing years, is still a U.S. record by a substantial margin. We'd never seen a 180 plus yield number, and we moved all the way to 186.5. That's that big crop that we had to use up. And I think what happened here in the quarterly grain stocks report is really kind of strong usage, kind of saying, yes, these USDA usage estimates, particularly the feed-in residual number, that 6.2 billion bushels, right in the middle of this table, that number, I think, which a lot of analysts had said, that number seems a little bit big to me. Don't you think? Mm-hmm. And I think that at least this usage estimate sort of says, no, I think we've kind of, tested this against where we think, actual grain inventories are, and it sort of seems to come out. Now, the only sort of maybe other point here is there's still a little bit of uncertainty about that export number. That 3.3 billion bushels is a big number for U.S. corn exports. We've seen a really strong sales pace for U.S. corn exports to date. All that grain still has to move. A lot of it has to even get off the farm, as we saw with the grain stocks numbers that exist today. All of that, though, puts us at still a 2 billion bushel plus carryout level and a stocks to use number that's well north of. I view that 10% level as kind of that knife edge level where we could see this market move dramatically higher. Now, I think that we're not so far from that 10% level that we couldn't see some upward movement. And we've obviously seen futures prices move up. We showed that graph. So that season average price forecast of 410 per bushel that was in the March WASDE, I think that number may come up a little bit. And that's really the only change that we have on the corn balance sheet. We'll move into the soybean stocks numbers next. USDA estimating March 1 national soybean stocks of 2.1 billion bushels. That's slightly above the average analyst's guess in the Reuters survey. It is bigger than quarterly grain stocks numbers for soybeans that we've seen in the last few years, but not dramatically so, and certainly not a historically especially large historic stocks number. If you go back to 2019, the high point in this graph, that was really sort of coming out of the onset of the first U.S.-China trade war, and there was real concerns about U.S. soybean exports as there are now, but we're not seeing that same dramatic build in stocks that we saw at that point in time, and I think that's kind of underpinning some of the price action that we showed early on. That number in the quarterly grain stocks for U.S. soybeans, slightly above where analysts' guesses were at, but really kind of very much in line with the kinds of misses that we've seen historically. In the neighborhood this year, 37 million bushels, very sort of normal miss by the trade relative to the number in the report. What this means for implied use, again, is usage very much in line with where we've seen it at in the last number of years. We don't see that same pattern of a sort of a consistent miss by the trade, or sort of not kind of corroborating or not calibrating production relative to usage that we saw with corn. And so I think this is a situation where it really speaks to how the market does have a pretty good handle on soybean usage. I mean, we have, in a sense, because that feed number, that that residual number is very small on the soybean balance sheet, because the usage categories are all measured. We can really pin down soybean usage in a way that we can't with corn, and that makes it a little bit easier to kind of get a handle on the overall supply and demand situation. We'll move to that. Here's the U.S. soybean balance sheets. A year ago, the current marketing year, 25-26, as estimated in the USDA's March WASDE. And then our revisions from that on the supply side, I see no reason to really sort of move away from where USDA was at. So the top half of the table, sort of, again, all the same. I think there are some things in the report, plus sort of what we know about what's happening with grain supply and demand this year, that would kind of lead us to think that maybe there's some room for some tweaks to the balance sheet as we go into next month's April WASDE report. Scott, you sort of see room for some change on the crush side. Now, domestic crushing has been, pushing the pace. I mean, certainly higher than any level that we've seen in the past in terms of just the number of bushels of beans crushed. But you see maybe some room to even push that a little bit further relative to the 25.75 number that was in the March WASDE.
Basically, and we'll talk a little bit more about this later when we talk about the new crop, but the big driver in the soybean sector is basically U.S. biofuels policy, the mandates, or some people call them the RVOs. And starting in the second, by summer, we're going to begin to need to run the U.S. soybean crushing business in the U.S. pretty much flat out. We're close to that now. Basically, we're going to find out what something close to 100% capacity utilization looks like in the second half of calendar year 2026 and throughout 2027. So that's the reasoning for continuing to bump that up even a little bit above what the USDA is carrying a big number with. I think that might be a little bit bigger because of what we're going to see on biofuels policy, but we'll talk more about that in a few minutes.
Yeah, I think now at the same time, we have seen a disappointing U.S. soybean export program. We did make up some of that with export sales to China that came maybe a little bit late, and that sort of kind of corroborated in the quarterly grain stocks report with those, soybean stocks that are growing off farm. So some of that, that flow of the bean crop seems to be moving to market maybe a little bit later than it would otherwise. But overall, relatively disappointing U.S. soybean export program. That's in part reflected in the March numbers. But if you look at pace of use and other sort of typical ways of looking at U.S. soybean export data, I think there's maybe room to sort of offset any growth in domestic crush that can be left for this marketing year, with some declines in the export number. And so we sort of see overall those two things basically offsetting each other, leaving us with a stocks to use picture that's very much in line with the USDA's March WASDE number, about 8% stocks to use. That's not sort of historically burdensome, but nor is it especially bullish for old crop. Now, obviously, we are seeing prices at present that are well above that season average price number that's in the USDA in the WASDE forecast. So possibly some room to bump up that season average price forecast. Where we might get to in terms of actual sales made could be a little bit higher than that 1020 number, but a lot of the price is baked in. A lot of those beans have moved off farm, and I think that's a source of a little bit of regret among people who had soybeans to market coming out of the 2025 crop. That a lot of those beans got sold at harvest at prices that were much lower than the prices today. That's the state of the situation. But all of that means the season average price forecast may move up, but not a whole lot. Okay. That leads us into prospective plantings. This is one of Jim Baltz's great photos. I just wanted to comment on this. Someone's going to make a comment about how those planter bin lids need to get closed before at some point. So I noticed it too. Don't worry. But it's part of the great visuals that we have from our man behind the scenes. Jim does a great job. We're going to talk a little bit about prospective plantings here. Now, Jim notes that this is part of the research enterprise of the U of I, and so this isn't sort of commercial soybean planting. That 8-row planter now is probably a little bit of an anachronism for a lot of operations. But anyways, we move into the prospective plantings report. Where we start is with overall crop acres, and how big is the acreage pie that we need to allocate among different crops as we move into the next year. So this graph shows the sort of long-ish run trend, what's happened to the overall size of that acreage pie over time. Really think of that as having three components. The first one being actual crops that actually got planted. Those are the green bars here, and that's most of this. So you'll notice that the y-axis here is cut off at 290 because we are indeed planting just over 300 million acres of what are called principal crops. That doesn't include things like fruits and vegetables or nursery crops, but think of what we think of as row crops. Over 300 million acres of that. There's lands that are in the conservation reserve program that can be conceivably thought of as part of that acreage pie. And then the other part are acres that don't get planted, what we'd call prevent plant. The sum of those three things has declined really since the boom period around 2012, when we saw very high corn and soybean and other crop prices. We planted a lot of acreage coming out of that. Since then, that acreage declined pretty dramatically between, say, 2013 and 2018. And then since then, a relatively slow and very slight decline. You could talk about different reasons for why that's happening, whether that's, land that's coming out of ag production getting developed for, whether that's, energy, commercial or residential property, all these things. But we really are seeing a slight decline over time in that acreage pie. And USDA's current estimate for principal crop acres kind of keeps corroborating that story. We're going to be down about 1.5 million acres, declining in principal crop acres from 311.5 million down to 310. We might see a little bit of that come back with, I think I've read a number of things suggesting that, conservation reserve program enrollment this year may be, slightly stronger than in the past. And we have seen, multiple years of year-over-year growth in CRP acreage. So that number in this graph is a projection. It's not something we know for sure today. And then if we assume sort of normal levels of prevent plant, I'm taking here the average over this period since 2013, excluding the anomalous case of 2019, where we had almost 20 million acres of prevented plant, puts us at about roughly 5 million acres of prevent plant that we would expect to happen based on sort of the normal set of weather conditions that might prevail in different parts of the country at harvest. We're going to see some prevent plant acres. Question is how many. all of that gets us to a year-over-year decline in the size of the acreage pie of just over 1 million acres. So lots of room then to sort of think about how do we allocate those acres among crops. Really, we're seeing that acreage decline come in all parts of the country. So this is sort of showing that decline in principal crop acres across states. Really, again, all of the major ag production regions in the country seeing some declines in total principal crop acres, at least as estimated by USDA.
And no explanation for my home state of Iowa.
No, that one kind of sticks out like a sore thumb. Now, I think we should say that an increase of 0.2 or 200,000 acres is probably not something we're going to work especially hard to try and explain. But that Iowa does stick out like a sore thumb here in this map. Otherwise, yeah, the story is these kind of little bits of ag land kind of coming out of production everywhere for a variety of reasons. There's not sort of one big thing, and there's not sort of this, I don't think, view this as a major decline in U.S. crop acres. It should be noted that the size of the acreage pie, I think USDA does a fairly good job of pinning down. This just shows the history in terms of where are total principal crop acres relative to this initial intentions as reported in the March Prospective Plantings report. USDA tends to come in, roughly within 0.5 percentage point of where we end up being at the end of the year. So don't view that overall acreage pie as moving a whole lot. Again, this is kind of the slow moving piece. Where we can get more action is the allocation among crops. And certainly we saw that last year, right? We saw a big swing towards corn acres away from beans, even relative to what was intended in the March Prospective Plantings. We just kind of kept finding corn acres all over the place.
They just kept showing up for 6 months.
And surprising us all. In that allocation process, obviously prices and the sort of relative prices tend to be a pretty major factor. I think the trade sort of expecting, obviously, a swing back away from that huge corn acreage number and back towards soybeans. So this graph just shows the price ratio during the month of February, which is both the price discovery period for crop insurance and kind of a good indication of the sort of the expectations about relative prices that farmers might have going into the planting season. That ratio swinging back towards soybeans just above 2.4. Would sort of skew towards beans and away from corn based on the price, relative prices that we saw during the month of February. Now, I think it should be noted, things have updated a little bit since then. We've seen real strength in soybean prices, new crop soybean prices moving up relative to corn. So that's what maybe sort of skew this even more towards beans. A lot of concerns about the fertilizer supply situation and debate about sort of how salient that really is. But the market expecting a shift back towards soybeans and away from corn. The question is to what degree?
I just want a quick comment. In the analysis that I've done from this point in the season, at least historically, changes in price ratios from this point on don't have much correlation with changes in corn and soybean acreage. The one variable that does is actually weather. And if we have good open planting conditions, corn acres tend to grow. And so that's something to keep an eye on as we start the planting season here. What the weather's going to look like in April basically can have an impact on any adjustments in acreage from here.
Yeah, I think certainly as of now, you wouldn't sort of be too concerned about weather, but obviously a lot can change in the course of weeks in terms of the ability for the U.S. farmer to get the crop planted. As of now, I think you'd say we should be good to go. We're not sort of excessively wet in most parts of the Corn Belt, but that can change in a hurry, as we have seen in different cases in the past. All right. So what did USDA say about corn and soybean planted acreage? Top graph here just showing the history of planted acreage. Obviously, last year was anomalous in terms of this swing towards corn. The trade estimating or predicting a decline from that 98.8 down to 94.4. USDA coming in slightly above that, estimating that the U.S. corn planted acreage will be 95.3 million acres in 2026. Now, the bottom half of this graph is showing sort of how did these initial forecasts, the one released now in March, and then also the number that we'll see in June in the June acreage report that comes out typically on June 30th. I don't know if June 30th is a business day this year, but at the end of June, how much do we differ between what we see today, that 95.3, and where we might end up being at the end of the year? There is some substantial room to move between now and then, and sometimes the USDA does a good job of getting closer to the actual number by June, and sometimes they don't.
Like 2025,
like last year. So here they actually got a little bit further away last year than where we ended up being, and that's still, I think, the point to be made that there's a lot of uncertainty about planted acreage, and that planted acreage number is really possibly could be the most influential number on the balance sheet. We can debate about that, but it's a big deal in terms of thinking about the overall size of the U.S. crop and what that might mean for a price level that needs to ration that corn supply out through the marketing year. This graph just showing where did those changes come. The Corn Belt here, sort of focusing in on Illinois and surrounding states, really everywhere seeing declines in corn acreage in and about the amount that we saw in the report overall. So a 3.5% decline in U.S. corn planted acreage overall. That's pretty much in line with the numbers that we're seeing in Illinois, Iowa, Nebraska, other major producing states. At the margins, maybe some places planting a little bit more corn, but all of the key production areas seeing these sort of slight declines.
I think kind of the two that stand out to me that are going against the trend are Kansas and Texas. And what exactly is behind the increases in corn there? I suspect it has something to do, at least in Texas, with, and maybe in parts of Kansas, declines in cotton profitability.
Yeah, I did briefly look at the cotton acreage estimate, and that number seems to be down pretty dramatically, and that would be consistent with, or relative to where the trade thought, and that would be consistent with that story for sure. All right. What does this mean for the new crop supply and demand situation? So if we just plug in that 95.3 million estimate, that's a change relative to the initial USDA 2026-27 balance sheet that we got back in the February Outlook Forum. So that's, at least as of now, the only sort of official USDA numbers for the new crop balance sheet. We won't get a true new crop balance sheet until the May WASDE report. But here's where USDA was at that third column showing the February Outlook Forum numbers, where they estimated planted acreage at 94 million acres. They have a 183 trend yield. I see, based on today's report and sort of my own analysis of trends in U.S. crop yields, I think there might be even room to move that number, both of those numbers up. And that's what we do in the last column here, that farmdoc forecast column. We see slightly higher planted acreage, slightly higher yield, combined with the large beginning stocks that we'll carry out of last marketing year. And I think we'd say no reason to change those expectations based on the grain stocks report. That gives us U.S. corn production that's just shy of 16 billion bushels, a total supply of 18 billion bushels. That's less than last year, but still, second largest ever, a big-ish U.S. corn crop.
That's a big supply that we have to get allocated to the uses.
Now, USDA is building in some strength in use, but again, it's not as much as we, some of the things that we've seen in terms of how we used up that big 2025 crop. So they are predicting a feed and residual number right around 6 million bushels. That's historically large, but less than what they're building into the 25 balance sheet. Ethanol usage numbers that sort of are, again, historically similar. We don't view that number as changing a whole lot. And I don't know if, Scott, you would sort of have anything to say about, I don't think we would see dramatic changes in that ethanol usage number.
No, I think that, but if anything, the way the economy and the high gas prices are going, if that persists, that number could be a little soft.
Yeah. All right. And then the last piece is that export piece, which they are, I think you'd have to say the strong export sales pace, you wouldn't want to bet on that necessarily growing year over year, particularly if Brazil gets a safrinha corn crop that would kind of fill up the global balance sheet even more. That's going to put us at an ending stocks number that's very similar to where we're at this year, above 2 billion bushels. Stocks to use that's kind of slightly high relative to high price periods like we saw in 21 and 22, but not burdensome or excessively large in historic terms. I do think there's some room to see that season average price creep up for 26, that based on both new crop futures prices and kind of the kinds of usage strength that we saw. I think we'll see prices slightly above where expectations were at, but not a dramatic change in U.S. corn prices. Any other thoughts, Scott?
Well, I think that what's interesting is if you look at the projected stocks to use ratio that we have there of over 13%, yet we are projecting higher prices and see room for that to go up, but is a part of this story, kind of the larger narrative of the strength coming out of the soybean sector that's going to spill over into the corn market.
Yeah, I think that's definitely the story, and it makes it a great time to sort of talk about soybean planted acreage. Here we're seeing that the history of soybean planted acreage since 2013 on top. We've obviously planted more soybean acres historically, particularly in that sort of boom period for U.S. exports in 2015 through 2018, planted a lot more beans than we really have since. So we got up to about 90 million planted acres in 2017. Haven't gotten back there. We were well below that last year. We're seeing this rebound. The trade expecting 85.5 million acres in the Reuters survey. USDA's actual number is 84.7 million acres. So slightly below where the trade was at. And really kind of the swing is just, we didn't get quite as many bean acres as we thought. We got slightly more corn acres than we thought. The story in terms of like, where do we go from here with that number, that 87.4 is, well, still a lot of time and a lot of uncertainty about where could things be, where could things go with that soybean number. We do see, USDA doesn't necessarily get a lot better in June than they did in March in terms of pinning down that final acreage number. Sometimes yes, 2025 no. But that's sort of will be, again, a source of a lot of uncertainty as we move forward. In terms of where is this happening, again, kind of very similar to the corn acreage shift. It's kind of coming a little bit from everywhere. So all of the major soybean producing states, particularly Iowa, right in line with the national change. Maybe a few more soybean acres coming into production in places like South Dakota, Nebraska, Kansas, sort of the western half of the Corn Belt. And then maybe, you might say Michigan and Ohio is kind of anomalous cases here where soybean acreage is predicted to go down a little bit, but really it's a broad-based change.
And don't forget our friends in Missouri, they're down as well.
They are.
They now stick out like a sore thumb.
Well, and they've got now, both a sore thumb and a boot heel, as we might say. All right. So that's the geographic distribution of those planted acres. What does it mean for the balance sheet? Again, we're decreasing soybean acreage slightly. We didn't get quite the swing back towards beans in the prospective plantings report that USDA was anticipating in its February Outlook Forum numbers, that the trade was anticipating in its pre-report guesses. But a number that puts us very much in line with production over the last number of years. About 4.4 billion bushels of U.S. soybean production expected this year, just slightly below maybe where you get with that USDA export form number. Looking at trends in yields, again, I sort of view USDA's 53 number as one, right in line with what we did in 2025, very much in line with linear trend kind of projections of historic yield data. Where there's a room for maybe a little bit more variation, at least in this point, just in terms of like pinning down that ending stocks to use ratio, is on the use side. And I think, Scott, you have a lot of optimism about U.S. soybean crush, and we built that into our numbers here with a fairly decent sized increase in U.S. soybean crush, that we're going to be pushing U.S. soybean crush capacity to the limit in 26-27. At least that's maybe your expectation.
Yeah, and comment on that just briefly. This is all being driven by the new renewable volume obligations, or RVOs for short, that were announced last week by the U.S. Environmental Protection Agency. We've had, and first off, the key category is what we call biomass-based diesel, which is largely, mostly made up of traditional FAME biodiesel and a newer fuel, renewable diesel. And there'd been a lot of political pressure to increase the biomass-based diesel mandate for the U.S., and the EPA awarded that pressure. So for 2026, the calendar year we're currently in, and 2027, the mandates over just 2025 are up about 60%. Huge increases in those mandate levels. And so when you bring it back, what's that mean for the soybean sector? Well, it all has to kind of start off, well, how much feedstock are we going to need to feed those mandates in the 26 and 27 calendar years? And these are kind of rough estimates right now. I'm working to refine them better. But right now it looks like we'll need about 50 billion pounds of feedstock in 2026 to meet those mandates. And that'll jump to over 60 billion pounds in 2027. Now, those may sound like, well, they're just numbers. Well, the 60 billion pounds in 2027 represents roughly half of all global fats and oils supply that can be used to make biomass-based diesel. And you have to let that number sink in a little bit. Half. So the U.S. is just exploding our demand for vegetable oils and animal fats and waste greases to be made into FAME biodiesel and renewable diesel. And so there's a big debate about, okay, how much increase in feedstock demand is going to go to domestic U.S. soybean oil versus imports of other kinds of fats and oils. But the bottom line is the overall number is so big that whether the U.S. in essence gets that feedstock business or somebody else, it's going to move global markets. And basically the message is, particularly as we get into the 26-27 marketing year, whatever new capacity comes online, it's going to tremendous pressures to bring it on as fast as possible, ramp it up as fast as possible, and for the U.S. to just make as much, crush as many soybeans as we can in order to contribute to these tremendous increases in demand for fats and oils to make biofuels. And so can we make, almost 2.8 billion in 26-27? That's probably a little bit heroic given where we think capacity is, but I think the incentives are going to be there, if anything, for continued surprises, because the market pressures are just going to be enormous as we go through the next 18 months, particularly once we get to the second half of calendar year 2026. And that's the wind now behind the sales of the corn and soybean sector in the U.S. And you can talk about it in being reflected in our price forecast here, Joe.
Yeah, I think so. I think it is part of this like longer run pivot in the U.S. soybean market towards domestic demand and away from export demand. And so if anything, I kind of view that export number USDA has in the outlook for them as being, a little bit heroic given the large Brazilian crop that we see coming to market, right now, the state of, US soybean pricing relative to its competition in Brazil. If we look at spread between, say, New Orleans port values and port values down in Brazil, Brazil's a lot cheaper. And all of that maybe puts a little bit of, the headwind here is, we've got to fight against that, and the expectation that export numbers are going to maybe be a little bit disappointing,
and especially
into the next year.
If the biofuels policy, basically increases the value of soybeans in the U.S. through the soybean oil channel, that makes our exports even more expensive and a little less competitive on the whole soybean side.
Indeed, and so. This is obviously sort of, I think, bullish for prices, but nothing comes for free.
Exactly.
There's no free lunch, as us economists like to say. And so we do see sort of a little bit give and take in the balance sheet overall, but the general idea being that in our projections here that ending stocks need to come down a little bit in the 26-27 marketing year. Stocks to use situation tightens up a little bit more, and we get what are really, I think, substantially higher prices. That $11 soybean price really kind of, I think, makes a huge difference if you look at the kinds of crop budget numbers that our colleagues on the farmdoc team put out. That really sort of changes the game in terms of soybean profitability.
Yep. All
right. So just sort of moving towards wrapping up and getting to the questions that you guys are submitting. Please do submit additional questions. We'll have some time to get through those here, I think, in just a few minutes. We'll look at just what did the market do in reaction to this. We can have opinions about what's going on. The market can make us look very, very silly. We want to recognize that. But I think, the market reaction, in my view, very consistent with the story that we've been telling. We've seen on the left what happened to corn prices in the hour-ish around the report release at 11 a.m. Market jumped just slightly, on the order of 5 to 6 cents. We're still in a very similar place. The market's at now. Here as we move towards we've gotten through the close of trading here today. Slight jump in corn prices, really nothing changing the overall supply and demand situation. And that's kind of consistent with the balance sheet data that we showed you. Where we have seen a bigger price reaction is in beans. The price moving, on the order of about 20 cents per bushel, from around 11.40 just before the report was released up to 11.60 per bushel on the new crop November contract. So definitely saying, we do think this this swing towards bean acres is not enough to kind of fill up the balance sheet in the way that would be needed to deal with the kinds of demand factors that we expect to see coming down the pike in 2026 and beyond. And we really need, slightly higher prices to kind of address that situation. Scott, any other sort of thoughts about?
I think as you look at this chart, is a perfect illustration of the overall main driver in the markets. We've been kind of coming out of a long period of corn and soybean prices driven by an ethanol boom. And now we've switched to the sector really be reflecting the boom on biomass-based diesel on the soybean side, that it started in 2021, was really hot for a couple of years, then it leveled off, and now it's taking off. And that's really the context for why the soybean market is really looking very sensitive to a million acres less planted soybean acres than you might expect.
Yeah. So just to summarize that, the grain stocks report showed, we're getting robust use of U.S. corn. Not much change in sort of our old crop expectations about soybeans. I think the grain stocks report was very neutral for soybeans. Where we are sort of seeing, I think, and what corroborates the price reaction that we've seen post-report is, with this continued slow decline in U.S. crop acreage and the kind of inability for the market for farmers to fully kind of get to the soybean acreage expectations that the trade had. We saw this swing from corn to soybeans being 1 million acres less than expected. We've really seen the soybean prices be the driver. Soybean prices now certainly, I would say, maybe more than slightly above long-run average levels. Corn prices are truly only slightly above those long-run average levels. And we're moving out of this kind of, I think, cyclical low. We certainly saw very high prices for all ag commodities in and around, in that post-COVID Ukraine war time of 2022-ish. We've seen kind of multiple years of lower prices. And I think we are kind of moving away from that to some degree due to, I think the big thing that's changed is not sort of anything that's materially different on the production side. We still have, I think, the ability to produce a lot of corn and soybeans if we want to, but it's really a demand-driven rally. And those are tends to be the kinds of rallies that have kind of the staying power that last for years, not months. Are those demand-driven rallies, and that's really sort of seems to be the nature of the situation today. Any other last thoughts, Scott?
Nope, I think you put it perfectly.
All right, that rarely happens, but every once in a while, I try to put it perfectly, as Scott said. I'm going to take that. I'm going to take that to the banner and write that down, Scott. All right. Before we move to questions, I just want a few housekeeping notes. We want to alert you of an upcoming webinar. What does this all mean for the farm? My colleagues, Dr. Gary Schnittke and Dr. Nick Paulson, will return with management strategies for low returns and high uncertainty. And I think the one thing we maybe didn't touch on is that there still is a lot of uncertainty. We still will have we're moving into that period of a weather-driven market as we go into the planting season and beyond, where a lot can change in the supply and demand situation.
I mean, you can just think of the potential shocks to the U.S. and the global economy from the current conflict in Iran, and if that has the potential to turn into a recession, it may or may not, and that could make all of our demand optimism look overdone.
Indeed, a lot changes if we do see the kinds of oil prices, energy prices that are being, talked about, and those are global markets, and that situation really will have an impact. I think that's what Gary and Nick will discuss. What does that mean for farm management, and think about the kinds of management strategies that producers can employ in the face of those kinds of events. In addition, we'd like to thank our sponsors, the TIAA Center for Farmland Research, CoBank, Compeer Financial, Farm Credit Illinois, FS Growmark, the Illinois Corn Growers and Illinois Soybean Association, and then John Deere, all of which make the FarmDoc project possible. Also, thanks to our educational partners, the College of Agricultural, Consumer, and Environmental Sciences here at the University of Illinois, the Department of Agricultural and Consumer Economics, Illinois Extension, the Gardner Ag Policy Program, and Illinois FBFM, really key partners in providing the kinds of news and information that we're able to provide through FarmDoc. So with that, we'll take questions that you have. As always, reach out and connect with us through the many channels that we have, whether that's through social media. You can email us directly. All of that information available on our website, farmdocdaily.illinois.edu. With that, we'll move into questions. Scott, where do you want to start?
I think I'll take E15.
Okay.
I'll take E15 for 100, Joe.
Sounds good. So the question here was, the market needs to kind of catch up with your story. A lot of talk right now about should we push to year-round E15? That has a lot of connection to the current oil and sort of gasoline supply and demand situation. This person's also thinking about the impacts of all of these sort of biofuel stories on food supply chains and supply sort of situations there, especially the demand, the supply and demand for protein.
Excellent question. Let me first take E15. Gets a lot of headlines, but it's not likely to have much market impact where we are today, based on all that has happened is we have renewed emergency waivers that allow retailers to sell E15, that's 15% ethanol blends in gasoline, in the summer. And that's only for, I believe, 8 Midwestern states. So it really has very little, if any, short-term market impact. My second comment on that would be, and even if legislation is passed that provides the needed RVP waiver permanently for the entire United States, that simply basically opens up more of an opportunity for E15. And it's not like we're suddenly going to be using 5% more ethanol in all the gasoline in the United States. In other words, the waiver is not a mandate. It's a market opportunity. And so that's important. The other comment on protein markets, what this questioner means is livestock. So this is a very kind of unique difference between the corn ethanol boom and the biomass-based diesel boom. In the corn ethanol boom, the rise in ethanol demand raised corn prices, which dramatically raised feed costs for livestock producers in the U.S. and caused some real financial hardship when initially the ethanol boom took off. The biomass-based diesel boom, often called the renewable diesel boom, is different, at least as it works through the soybean sector, because in order to get the biofuel feedstock you need soybean oil, you get a lot of extra, in essence, soybean meal that has to be crushed to get the oil. And so some of the beneficial impact in the soybean sector for soybean farmers from the increase in the mandates gets offset by this decrease in the price of meal, which incidentally then is a benefit to livestock producers. So in this case, it is an example of a biofuel policy that benefits both soybean producers and livestock feeders. It's really different that way.
Interesting. Next question. This one's at least the most straightforward is, could you elaborate on your view on new crop soybean or new crop corn yields, excuse me. And I think I'm slightly more optimistic than USDA is about new crop corn yields. And the story there, I think, is a relatively simple one. I think what we saw in 2025 kind of confirmed the long run-ish projections that we had for U.S. corn yields that go back multiple years. So I think the last few years we've seen that trend yield curve kind of slow slightly. And that's where USDA is getting at 183 number. And I view that as that shift as somewhat temporary. And I think 2025 kind of corroborated that for me, that the kinds of yield numbers that we were throwing around that year. The thing to note is the trend line adjustment in U.S. corn yield means we're going to grow our estimated yield or our yield expectation at about 2 bushels per acre per year. Every year, we should update and think like the average yield in the United States can go up 2 bushels per acre. And so I view that 183.5 number as kind of putting us more in line with where trend yields had been at a few years ago, and where I think kind of 2025 showed me they could get to again. And so that's my story that I'm telling there. I don't know if Scott,
I agree with that. And in fact, I'm even a little more bullish on personally on corn trend yields than this was appropriately. I would call it a little on the conservative side. My analysis would suggest that the U.S. that the correct estimate of the U.S. average corn trend yield should be someplace between 184 and 185 bushels an acre. That's where I'm at, is in that range. And it's very consistent with, if you look back for 50 or 60 years, the long-term trend rate of growth in corn trend yields in the U.S. is remarkably consistent.
Indeed, it is absolutely. I think that you look at the data and you're like, this can't be this straightforward,
and it is,
and it's been that way for decades,
almost my entire life.
All right, let's get at least one last question. What is the impact of the Middle East conflict on our forecast? And I think the one thing to note is all of these numbers come out sort of representing the situation as of March 1st. And obviously a lot has changed in the world since March 1st. So what do you think about sort of, say, higher nitrogen input costs? A lot of talk about how that might influence planting intentions at this stage. How's that going to impact grower decisions for those who, especially those who hadn't secured all of their crop nutrient needs as of sort of the going into the planting season as of March 1st?
My personal view is yes, there probably can be for those that haven't secured their nutrient inputs, a small swing away from corn and toward beans. But I would put it, if whatever swing we see in June, I expect it to be in the hundreds of thousands, a few hundreds of thousands of acres, not in the millions.
Yeah. So with that, I know we're at time. I want to thank you all for joining us. We really do appreciate you being along for the ride as we walk through the latest USDA numbers. I want to thank Jim Baltz, who makes these webinars possible, makes them look so good. For my colleague, Dr. Scott Irwin, I'm Joe Janzen. This has been a FarmDoc Daily webinar. Have a good day.